Hey everyone! Welcome back to our channel. Today, we're going to delve into the nitty-gritty of analyzing a real estate deal. Whether you're a seasoned investor or just starting out, this step-by-step guide will provide you with the tools and knowledge to make informed decisions. So, let's get started. Before we jump into the analysis process, it's important to understand that every real estate deal is unique. There's no one-size-fits-all formula. However, by following these steps, you'll have a structured approach to evaluating potential investment opportunities. Number 1. Define your investment strategy. Having a clear investment strategy is crucial because it allows you to focus your efforts on properties that align with your goals. For example, if you're interested in long-term rentals, you'll be looking for properties in stable, high-demand areas with good cash flow potential. On the other hand, if you prefer fix and flip properties, you'll be seeking properties with value-add potential, such as those in need of renovations or located in up-and-coming neighborhoods. Defining your investment strategy not only helps you narrow down your search, but also ensures that you allocate your time and resources efficiently. So take the time to assess your investment goals and establish a clear strategy before diving into the analysis process. Number 2. Identify potential properties. When identifying potential properties, it's important to cast a wide net and explore various sources. Online platforms like real estate websites and marketplaces can provide a wealth of options, allowing you to filter properties based on your criteria. Additionally, working with experienced real estate agents who specialize in your target market can provide valuable insights and access to off-market deals. Networking within the real estate community can also lead to potential opportunities and partnerships. As you evaluate properties, consider their location in terms of proximity to amenities, schools, transportation, and potential future development. Property type is another important consideration, as different types, such as single-family homes, multi-unit buildings, or commercial properties, have varying investment potential. Lastly, assess the condition of the property, as renovations and repairs can significantly impact your investment costs and timeline. By thoroughly considering these factors, you can narrow down your options to the most promising properties for further analysis. Number 3. Gather property information. To gather comprehensive property information, start by examining the specifications provided by the seller or listing agent. This includes details like the square footage, number of bedrooms and bathrooms, lot size, and any unique features. Additionally, assess the current condition of the property by conducting a thorough inspection or hiring a professional inspector. This will help you identify any existing issues or repairs needed, which can impact your budget and timeline. If the property is currently rented, request the rental history to understand the income potential and tenant turnover. It's also important to factor in any additional costs, such as property taxes, insurance, HOA fees, and potential renovation or improvement expenses. By gathering all relevant property information, you can make a more accurate assessment of its potential value and calculate a realistic return on investment. Number 4. Evaluate the financials. When evaluating the financials of a real estate deal, it's essential to consider both the potential income and expenses associated with the property. Begin by estimating the rental income based on market rates and occupancy levels. Take into account any seasonal or market fluctuations that may affect the property's rental potential. Next, factor in the expenses. This includes mortgage payments, property taxes, insurance premiums, property management fees if applicable, maintenance and repair costs, utilities, and vacancies. It's crucial to be thorough and realistic when estimating expenses to avoid underestimating the true costs of owning the property. With the rental income and expenses calculated, analyze the numbers to determine the property's cash flow, which is the net income generated after deducting expenses from rental income. Positive cash flow indicates a profitable investment, while negative cash flow may require additional consideration. Additionally, consider the overall profitability of the deal by assessing metrics such as the cap rate, return on investment ROI, and cash on cash return. These financial evaluations will help you make informed decisions and compare different investment opportunities effectively. Number 5. Conduct comparative market analysis. Conducting a comparative market analysis, also known as a CMA, is a crucial step in analyzing a real estate deal. The goal of a CMA is to assess the property's value in relation to similar properties that have recently sold or are currently on the market. By examining recent sales, you can gain insight into the local market and determine if the property is priced appropriately. Look for comparable properties that are similar in terms of size, location, condition, and features. Consider factors such as the sale price, days on market, and any unique attributes that may affect the property's value. Additionally, analyze market trends such as supply and demand, appreciation rates, and economic factors that could impact property values. A comprehensive CMA helps you understand the property's market value and provides a foundation for negotiations with the seller. Number 6. Perform due diligence. Performing due diligence is a critical step in the real estate analysis process. It involves conducting a thorough investigation of the property to uncover any potential issues or risks. Start by scheduling a property inspection with a qualified professional who can assess the structural integrity, electrical and plumbing systems, and overall condition of the property. This inspection will help you identify any hidden problems that may require costly repairs or renovations. Additionally, review all relevant legal documents, such as title deeds, leases if applicable, zoning regulations, and any pending or past litigation related to the property. Ensure that the property complies with all local building codes and regulations. Assess any potential risks or liabilities associated with the property, such as environmental hazards, encroachments, or easements. This thorough due diligence process will provide you with a comprehensive understanding of the property and help you make an informed decision before proceeding with the deal. Number 7. Negotiate and close the deal. Negotiating and closing the deal is the final step in the real estate analysis process. When negotiating, it's essential to communicate your needs and concerns effectively while also understanding the seller's perspective. Price is often a primary negotiation point, but other terms can also be discussed, such as financing options, contingencies such as inspections or appraisals, and a closing timeline. Collaborate with the seller or their representative to find a mutually beneficial agreement that satisfies both parties. Once the negotiations are complete and all terms have been agreed upon, the closing process begins. This involves the preparation and signing of legal paperwork, securing financing if applicable, conducting final inspections, and transferring ownership from the seller to the buyer. Closing costs, such as title insurance, transfer taxes, and attorney fees, will also need to be paid. By navigating this final stage successfully, you can finalize the deal and officially become the owner of the property. Making an informed decision is a critical aspect of analyzing a real estate deal. With all the information you have gathered throughout the previous steps, it's time to carefully assess the property's potential returns and how they align with your investment goals. Evaluate the property's cash flow, return on investment, and projected appreciation based on market conditions and historical data. Consider the risks associated with the property, such as market volatility, potential vacancies, and unforeseen expenses. Determine if the deal aligns with your overall investment strategy and risk tolerance. If the property meets your financial and strategic criteria, it may be a good fit for your portfolio. However, if the risks outweigh the rewards or the property does not align with your goals, it may be wise to walk away and continue your search for a more suitable opportunity. By carefully evaluating all the factors, you can make an informed decision that sets you up for success in your real estate investment journey. And there you have it, a step-by-step guide on how to analyze a real estate deal. Remember, thorough analysis and due diligence are key to making successful investments in the real estate market. We hope this video has provided you with valuable insights and tools for your future ventures. If you found this video helpful, give it a thumbs up, and don't forget to subscribe to our channel for more real estate tips and insights. As always, leave your questions and comments down below, and we'll be happy to respond. Thanks for watching, and we'll see you in the next video. Happy investing!